Hello everybody, my name is Polina Petrova, and today I will be discussing from AGI deductions, more specifically itemized deductions. I will cover pages 611 to 616. What we will discuss today is what is from AGI deductions, types of itemized deductions, medical expenses, which includes transportation and travel, hospitals and long-term facilities, and what is the limitation on medical expense deduction. The next category will be taxes and then interest. So before I start on medical expenses, let's say what is from AGI deductions. These deductions consist of the greater of itemized deductions or the standard deduction, which for 2019 is $12,200 for single taxpayer and $24,400 for married filing jointly, and the deduction of qualified business income. So, itemized deductions, and the first one is medical expenses. This deduction is given for taxpayers who do not have the ability to pay taxes and some serious health-related event happened to them. The qualified medical expenses include any payments for the care, prevention, cure of injury, disease, or bodily function that are not reimbursed by health insurance or are not paid for through a flexible spending account. This flexible spending account basically is any money before taxes. So, who can deduct the medical expense? Of course, the taxpayer who incurred the expense, his spouse, and any qualified dependents. Transportation and travel for medical purposes. Here, the most important question that we need to ask is, what was the main purpose for the travel? Was it to receive a medical care or not? If the main purpose was receiving medical care, then the taxpayer may deduct the cost for lodging overnight and transportation. Let's say the taxpayer uses his own vehicle to get to a facility to receive medical care, then he can deduct the standard mileage. For 2019, the standard mileage rate is 20 cents per mile. So let's give an example. During the last year, John drove 100 miles to the nearest hospital to treat his injured ankle. Is he allowed to deduct any expense? Yes, because the main purpose for John's travel was to receive medical care, and he used his own car to go to the hospital to treat his ankle. Therefore, he is allowed to deduct $20. Which is computed as 100 miles, the distance that he drove, multiplied 20 cents, the standard mileage rate for 2019, and that gives us $20. Hospitals and long-term care facilities. A taxpayer may deduct the cost of meals and lodging at hospitals because, of course, he receives medical care there. But is it the same for long-term care facilities? It depends. If he stays for convenience in a long-term care facilities, then the taxpayer is not allowed to deduct any portion of it. But let's say that if the 30% of the time he stays there, he receives medical care, then only this 3% will be deductible. Another example, Sarah pays $20,000 per year for a nursing home, and only 20% of the time she receives medical care. Sarah can deduct $4,000, $20,000 per year that she pays to the nursing home, multiply the 20%, the time that she actually receives medical care. There is a limitation on the medical expense deduction that is also known as floor limitation. The purpose of this limitation is to restrict the deduction to taxpayers with substantial qualified expenses. So let's see how that limitation is computed. It is the total unreimbursed qualified medical expense minus 10% of taxpayers' AGI. That gives us the deduction, the medical expense deduction that we are allowed to deduct, of course, if we decide to itemize. We should note here that for years 2017 and 2018, the percentage that we subtract from the total unreimbursed medical expenses is 7.5% and not 10%. Let's give us another example. Jane's AGI for 2019 is $100,000. She has $2,500 of unreimbursed medical expenses. How much Jane is allowed to deduct, if any? So her total unreimbursed medical expense is $2,500 minus 10% of Jane's AGI is $10,000. 100,000 her AGI multiplied by 10% gives us $10,000. And her medical expense itemized deduction is 0 because the total unreimbursed expenses are less than 10% of Jane's AGI. Let's talk about taxes. That is the second category of itemized deductions that we are discussing today. The taxpayer may deduct as itemized deductions the payment he made during the year for the following taxes: state, local, and foreign income taxes, which includes any payments throughout the year from employer withholding, any estimated tax payments, state and local real estate taxes imposed on personal or investment property, and state and local taxes that are assessed on the value of the specific property. A taxpayer may decide to deduct state and local sales tax instead of state and local income taxes. Why would they do that? This is an advantage for people who live in a state that doesn't impose state and local income taxes on its residents. Therefore, for them, it's more beneficial to deduct sales tax instead of income tax. We should know that there is a limitation on the deduction. The total state and local itemized deduction is limited to $10,000. What does that mean? If you pay property taxes and income taxes and all combined to $14,000, you're not allowed to deduct all $14,000. You're allowed to deduct only these $10,000. The third category of itemized deductions is interest expense deduction. The most important one here is home mortgage interest expense. So when you have a loan and that loan is secured by your home, then you're allowed to deduct the mortgage interest of your loan. It is important to know when the loan is acquired, because there is a cap of the home mortgage interest. So if the loan's acquired after December 15, 2017, the limitation is up to $750,000. If the loan's acquired before December 16, 2017, then the limitation is up to $1 million. Interest on loan used for purchase of investment assets. So if a taxpayer uses a loan to purchase investment assets such as stocks, bonds, or land, he can deduct the loan interest, but only if the interest equals or is less than the taxpayer's investment income. So let's say if I invest in land and I took a loan for $20,000 and my interest on that loan is $10,000, I can deduct it because it's less than my income. If I receive income of $20,000. My mistake. If the interest exceeds the investment income, it will be carried forward to the subsequent year. A taxpayer is not allowed to deduct interest on personal credit cards debt. As a conclusion, what is the most important things that we need to know? For medical expense, it is the question, what was the main purpose of the travel? If it's for medical care, then that expense is deductible. Also, it is crucial to know how to compute how much of the unreimbursed medical expense are deductible. And here is the formula that we already discussed. Regarding taxes, we need to know about the cap, $10,000, in order to be deductible. That is all combined state and local taxes, either income, property, or both. For home mortgage interest expense, is the loan secured by a home, and when was it acquired? If it's secured by a home, then the interest expense is deductible. And when was it acquired? It depends, either if it's going to be up to $750,000 or up to $1 million. Thank you for watching my presentation.